Hi, thanks for joining me today. It's Greg Watson here. I just want to, today's session is basically about showing you a little bit about flipping Wall Street and how the simulator works. It's actually really simple, and I just wanted to share some strategies with you today on how to put that together. First of all, just as a disclaimer, the example strategies are for demo purposes only. Robotic Trading Solutions, Flipping Wall Street, Greg Watson and the Investor Hub and affiliates don't make, buy, sell or hold recommendations. Unique experiences and past performance do not guarantee future results. We're software and marketing related companies and not licensed broker-dealers. Investing in the stock market can be considered high risk and participants should consult with their financial advisor regarding risk and suitability. So Flip is not about share market trading. Flip is a software platform that allows you to do that. So anyway, I want to show you a bit about how it works today. So I want to show you how the portfolio builder works. So at the moment you can see on my screen there's a trading dashboard. We start with a simulated account of $100,000. But what we need to do first is we need to put that into some stocks and use certain strategies. So I'll click on the portfolio builder, and as it comes, here we go. So here you'll see that we've got 100% cash at the moment. So 100% of the portfolio is in cash because we haven't allocated anything to it. I haven't gone very far down the alphabet here in selecting stocks because I don't want this to be about stock selection. I want it to be about demonstrating how the software works. So I'll just scroll down there. There's a whole list of, and there's another disclaimer at the bottom. There's a whole list of stocks here, and they will go all the way through all of the stocks that are, not all of the stocks on the New York Stock Exchange, but all of the stocks that have strategies and algorithms that have been tested and proven by the team at Flipping Wall Street to be able to work under the conditions on which they've tested them. So I'm going to just go down. I can type in the search bar here. I'm going to put in AEP. AEP is the American Electric Power Company. So I'm going to click on that, and you can see there the chart on the right-hand side. It's been up and down and down and along a bit. So it's been floating around for a while. I'm just going to go down to the strategies. So there's a whole bunch of strategies here called Turtle Wide, Turtle Max, Basic Stop, Mesa, and First Profit. So there's 2, 4, 6, 8 strategies there. Sorry, 2, 4, 6 strategies there. You'll find on some other stocks that there can be as many as 10 strategies, 8 or 10 strategies. So I'm just going to click on the Turtle Wide one, Details. I'm going to click on Details. That's going to show us how this would have performed over time. So that says 2010. That's not strictly true. That's over the last 7 years actually. So that's from 2004, up to 2017, basically up to current day. So it shows you the equity curve of, amount invested and what that would look like over a period of time based on the logarithms and how it would have traded. There's number of trading days, winning trading days, the worst drawdown, which was in 2009, which was $2,266. Total profit and loss over the period on this strategy was $11,500. And so the return on investment, 115.5%. Best day made $653. Worst day, lost $786. So by no means does this software purport to be an always win strategy, because there are strategies within each stock, I guess, which they'll win and they'll lose. It's just the risk management features within the software limit your exposure, I guess, and that's the key thing. So there's a monthly profit and loss here, and you see it goes all the way back to 2004 when they started their testing, all the way up to current day, basically. And you can see the annual profits are from minus 0.5% up to 20.8% there, and 22% last year. And you'll see that there's boxes that have got red numbers in them, and they're obviously the losing months. The winning months are in green, and there's a lot of months that have nothing at all. So what that means is the trader hasn't traded on those stocks during that period of time. It might have left the money in cash, just waiting for the opportunity for the conditions to be right for it to re-enter the market. So it's that's one of the risk management features, that it won't enter the market just because it's sold out of a profitable position. It'll wait for the conditions to be right under the algorithm for it to be able to profit again, I guess. So anyway, we're going to go back up, sorry. We're going to change. We need to change our settings first. And we're going to add, excuse me, we're going to add that turtle wide strategy. Done. Okay. So that's strategy number 1. And that will now, so that now shows that's pending. So I'm going to save those changes, and I'm going to confirm that. That's for now. So all it's done basically is it's put 10% in that strategy, and it's going to go to the dashboard, and it's going to show us that just with that strategy running, it's made $4,961. Anyway, we're going to go back to the portfolio builder, because we need to build the whole portfolio, not just one bit at a time. So, excuse me, the second one that I want to add is Adobe Systems Incorporated. Now, again, they have a number of different strategies there, but there you can see there they've got annual returns ranging from 24% down to 14% with different Sharpe indexes. I'm just going to pick this one down here. First Profit, it's got a higher Sharpe index than all of the others. I'll tell you about Sharpe indexes in a minute. Or is it Sharpe indices? So we're going to hit change there, and we're just going to add that in straight away. And that's good. So we've put an extra one in there. We're going to back up again. We're going to go to Amazon. Amazon's a great success story, isn't it? So we're going to go to Amazon just because it's there and it's still A. Amazon, again, has a number of different strategies. We're going to pick the First Profit one again. Details, add that strategy as well. Then we're going to go back. We're going to select Boeing, because Boeing's a little bit different. Right, there's some interesting things with Boeing. Because I obviously did some research with this. So there's a whole bunch of different strategies again. I'm going to pick this turtle strategy. Now, if you want to know what all of these strategies mean, there's Turtle and Mesa and First Profit and Max. All of this is included in the education system that's included with Flipping Wall Street. So what you can see here, again, is ignore the 2010 at the bottom there. That's just a number. That's not indicative of the whole time frame. Again, that's from, you can see there, that's from 2004 up to 2017. So there's a lot of flat spaces here, and there's some dips. They've obviously, gained and lost some money there because the strategy said to lose out before it loses too much. To pull out before it's lost too much. But you'll see these flat spots like here, for example, and that goes from the 28th of September 2007 all the way through to September 2009. So for 2 years, it was doing nothing. So the conditions weren't right under the algorithm for it to trade under this strategy. So it's actually done nothing. It's kept the money in cash because the conditions aren't right. So if it had followed the share market, it could have been up and down and up and down and up and down and down and down, or down and down, and it's pulled back in here again. It's lost a bit of money, but then it's gained. So there's obviously gains and losses along the way, but I just wanted to demonstrate the flat periods, because that means the trader is actually out of the market. It's not in the market at all, and it's keeping your money in cash to using the risk management functions under the software to be able to protect your capital positions. And that's that risk management stuff's really important from a trading perspective. So I've talked about that. The other thing I wanted to talk about just before I go on with the rest of this is Sharpe index. I'm going to go back here a second. You see under Boeing here, there's a whole lot of different Sharpe indexes, 0.72, 0.53, 0.54, 0.62. There haven't been any really high ones in any of the shares I've chosen, just because I've simply chosen them and I haven't gone looking for really high ones. So I'm just going to go to Investopedia, which has given me definitions for what a Sharpe index is, or Sharpe ratio, and it's thus. The Sharpe ratio is a measure for calculating a risk-adjusted return, and this ratio has become the industry standard for these type of calculations. It was developed by Nobel laureate William F. Sharpe, and the Sharpe ratio is the average return earned in excess of the risk-free rate per unit of volatility or total risk. So it's taking into account the returns and the risk. So according to Investopedia, a Sharpe ratio greater than 1 is good, greater than 2 is very good, and greater than 3 is excellent. Now you'll see all these ones don't have anything above 0.72. However, that is what it is. That's just based on the shares that I've chosen for this example. But I just wanted to let you know what a Sharpe ratio means. So according to Investopedia, the higher the Sharpe ratio, the better. So I'm going to come back over here to the portfolio builder. We've got 60% in cash. We've got 10% in each of these. I'm going to change this just so that we're still keeping some cash, but we're going to put 20% in each. Oh, it didn't change it. That's a bit rude, isn't it? It's 20% in each stock under these strategies. One moment, please. 20. Okay. So now we've got 4 strategies, 20%, 20% cash, which is a buffer. You know, you may or may not choose to do that. I'm going to save those changes, and that's going to change the portfolio allocation. I'll hit OK, and then it'll take me through to the trading dashboard because it'll calculate what all of that looks like over the period of time that we've allocated it for. So now, it's still thinking. There we go. Okay. So according to this portfolio, this over the period of time would have grown from $100,000 to $183,000, closed profit and loss of $83,000. What's really interesting is the funds allocated. So this is as of today, today being the 13th of March, 2017. But as of today, the system would have had, if we had this live, only had $39,000 live in the market because of those flat spots I was telling you about before. So it's taking more money, keeping more money in cash to wait until such time as it's right to trade and it's happy to trade. There's only one trade in that's live at the moment, and it's been doing that for 92 days. So that's the Boeing turtle strategy, and it's up by about $30 a share. So there's some profit there on the table really. So I just wanted to show you that for starters. It's a bit of a look at the performance on the trading dashboard. So regardless of the time that we started the trader running, it's still performing exactly the same. So the stocks that it's in today are the same ones that it would be regardless of whether it started a year ago or started 3 years ago or started 10 years ago. I'm going to go back to the portfolio builder again, and I'm going to flick this back to 3 years. Hit change. You can see how simple it is to navigate around this, and it's much easier once you get the hang of it. But of course, you know, it doesn't all happen automatically. You've got to learn to do that a bit first. But there's not very much learning. You know, I've been at this for only a little while. So I'm going to save that again. So now we're only looking at a short period of time, relatively speaking. We'll go back to the trading dashboard. Once it redirects us back there, it's going to populate all the numbers for us again because it's doing its calculations in the background. So it's made on those strategies. It's made it's made $28,560 over that period of time. It's still in the same trade here, but it's only got 22,000 funds allocated as of today. But it's still in the same shares, and they're still gone $145 to $178. So it's closed out $28,560 in profit. And I just wanted to show you how the portfolio builder works, how it simulates based on the strategies that are used. The other thing I'm going to do now is I'm going to do something a little bit different. I'm just going to take all of these up to 25%. See that cash has now dropped to 15. I've changed Adobe to 25. I'll change Amazon to 25. You'll watch cash go to 10 in a second. There we go. So it's taking the money from a cash allocation and putting it into a strategy allocation. So this would depend on whether you wanted, you wanted all your money in the market or you wanted to keep a reserve, and that would be absolutely up to you and the advice that you take. So that's going to now update that and then take us back. Remember, we had a $28,000 profit a minute ago. Now it's put everything in the market. Now we're looking at a $35,000 profit based on those strategies. And it's got a little bit more in the market. It's still in the market on the same shares, but it's only got one open position at the moment. So if I had a broader portfolio of, let's say, 10 different share strategies that had allocated 10% each, we'd be looking at obviously totally different. But I really wanted just to put a few in place today just to show you how simple it is to set up a trader in a simulation, and it's no different from doing it in simulation than it is in doing it in real life. It's very, very simple, and I just wanted to demonstrate that for you today. So if you've got any questions, please get in touch and we can have a further conversation. Thanks for listening, and bye for now.